Retained earnings statements are a vital part of financial reporting. They show what is left over from profit after all expenses have been paid, and the company distributed dividends to its shareholders. This video will give you an overview of what retained earnings statements are, why they matter, how they work, and more. Before we get started, if you want to hear all our tips on how to improve your business operations, then hit the subscribe button and notification bell so you don't miss our weekly uploads. What are retained earnings? Retained earnings may be crucial to your company's ability to finance growth, bring new goods to market, or enter mergers and acquisitions. To work out your retained earnings, you'll need to make a retained earnings statement. Retained earnings definition. Retained earnings is the term used to identify the amount of net income remaining in a business after dividends are paid to investors. As a result, retained earnings can be positive, i.e. a profit, or negative, which is a loss. Retained earnings, are they important? Retained earnings are likely to have a significant impact on the financial success of your company. If you have a positive retained earnings figure, you'll have more money to invest in development activities like research and development, new building facilities, and much more. This profit can be used to finance mergers and acquisitions, to buy back shares, repay outstanding loans, or develop your company's current operational infrastructure. If firms don't believe that their retained earnings will provide them with good enough return on their investment, they may be given to investors. Beginning of retained earnings period. At the end of each fiscal year, retained earnings are recorded on the balance sheet as accumulated income from the prior year, including current year's income, minus the dividends paid to shareholders. In the next cycle, the retained earnings end balance from the previous period will become the retained earnings beginning balance. A negative RE balance may occur for a variety of reasons, including when the current period's net loss is greater than that of the RE beginning balance. A substantial dividend disbursement that exceeds their retained earnings figure can also push it into the red. Net income and retained earnings. Changes in net income will have an immediate impact on the RE balance. The retained earnings account might be negative as a result of significant cumulative net losses. Naturally, the same factors that influence net income also influence RE. Sales revenue, costs of goods sold, depreciation, and other operating expenses are just a few examples. Non-cash items such as write-downs or impairments, stock-based compensation, and non-cash charges affecting income. Dividends and retained earnings. Dividends may be paid in cash or stock, and the amount of cash payments depends on how much money is generated by the company. The reduction of RE value for a firm is dependent both upon the amount of revenue generated as well as how it distributes those funds to investors. A company's balance sheet and asset value shrink when it pays out dividends. Therefore, they are considered a cash expenditure. These reduce the amount of firm's liquid assets and decrease its asset value since it no longer owns a stake in them. Stock dividends do not require you to pay money. Instead, they give you more shares in the company that you own. This allocation does not change the size of our company's balance sheet, but it makes the value of stocks lower by a small amount. Retained earnings end period. At the end of the time, you may work out your final retained earnings balance on the balance sheet by adding any net income or loss, then subtracting any dividends. Negative and high retained earnings. In general, a company with a negative retained earnings balance is deemed weak because it indicates that the firm has incurred losses in one or more prior years. Having a lot of retained earnings might reflect a solid financial position since it demonstrates a track record of profitability in prior years. On the other hand, it may also indicate that the company's management is having trouble finding profitable investment opportunities for its retained income. Shareholders may prefer it if management were to simply pay out the balance of retained earnings as dividends in those cases. The retained earnings formula looks like this. End period retained earnings equals beginning period retained earnings plus net income or net loss minus cash dividends minus stock dividends. To put it another way, you only need to know the initial retained earnings at the start of your accounting year. Add the net income or loss, then deduct both cash and stock dividends. Your end period retained earnings will be the result. Understanding a retained earnings statement. The retained earnings statement is sometimes referred to as a statement of retained earnings, equity statement, or shareholders' equity statement. This report shows how your company's retained earnings have changed over a certain time. Simply stated, The statement reconciles your company's retained earnings at the start of the period with those at the end of the period by using data from other financial records. Many companies will add their retained earnings statement to a balance sheet. You need to follow the rules of GAAP, Generally Accepted Accounting Principles, when you prepare financial statements like this. What retained earnings tells us. The following 7 choices cover a wide range of ways a company may use its excess cash. Because dividend payments are irreversible, the first option leads to earnings money being removed from the company's books and accounts forever. The alternatives keep the money in the company and allow businesses to use them however they choose. The money that comes in is often distributed, fully or partially, among the company's owners in the form of a dividend. It might also be used to grow the company's current operations, such as increasing the manufacturing capability of existing goods or recruiting more salespeople. It can be invested to launch a new product or variant, like a new drink flavours, new furniture collections, and so on. The cash can be utilised for any merger, acquisition, or collaboration that promises to improve company prospects. The money can be used for share buybacks. The surplus cash may be used to pay any outstanding loan, debt, the firm owes. Management and retained earnings. The decision to keep the income or apportion it among shareholders is typically left to company executives. However, by a majority vote of shares, the shareholders can challenge this because they are the actual owners of the business. Shareholders and management may seek to retain earnings for a variety of reasons. The management may have a high growth project in mind, which they might think of it as a potential source of high returns in the future. In the long run, such projects may result in greater returns for company investors rather than dividend payouts. Paying off high interest debt is also more appealing to both management and shareholders than regular dividend payments. When a firm creates profit, some long-term investors may anticipate regular income in the form of dividends as a reward for putting their money into the company. The company's leadership usually takes a balanced approach. It necessitates the payments of small dividends while retaining a substantial proportion of revenue, resulting in a win-win situation. Benefits of a statement of retained earnings. A public statement of retained earnings is used to increase confidence in a firm and the market. It's a tool for tracking a company's health. Retained earnings are not synonymous with extra cash. Instead, the retained earnings are typically redirected, usually as a reinvestment within the company. To summarize, retained earnings are the company's total net earnings or profits after taking into account dividends. It also is known as earnings surplus and represents a firm's reserve cash, which may be used by management to reinvest back into the business. The percentage of earnings retained is also known as the retention ratio, which refers to how much earnings are kept after taxes. It can be found by calculating 1 minus dividend payout ratio as a proportion of total money earned. Though the option of debt repayment does not keep money in the business, it still has an impact on how much money is in the company. Profits provide a lot of flexibility to the business owners or company management to spend money. This profit is usually paid out to investors, but it also may be reinvested back into the firm for growth. The cash not given to shareholders is considered retained earnings. Important takeaways. The amount of net income left over for the organisation after paying dividends to its investors is known as retained earnings. In most situations, the board of directors retains the revenue or distributes it among the shareholders. This is generally left to management discretion. Because a growth-orientated firm may not wish to pay dividends or send out modest checks, it might want to utilise retained earnings for expansion projects. Does this help your understanding of retained earnings? Let us know in the comments what else you would like to learn about when it comes to understanding and optimising your business for better efficiency.